if you are depending mostly on your investment portfolio for passive income after retirement. Doing this is important to ensure that your portfolio is structured to minimize risk and maximize potential returns. Now, when a client comes to us with a 3 million retirement portfolio, it may seem like a substantial amount. However, a deeper discussion reveals that the way the entire investment or retirement portfolio is structured exposes it to a lot of downside risks. We run simulations on the entire portfolio, which consists of pension funds, stocks, ETFs, to determine the chances of a portfolio surviving over 10 years, 20 years, or 30 years time horizon. And we take into account the asset classes and the expected annual withdrawals, and of course the inflation rate. Now, all this, we look at it, we run simulations, and we can tell the client that the chances of his portfolio of 3 million today lasting for 30 years are only 35%. That is like a doctor telling you, before you go into a surgery, to say there's only a 30% chance of you surviving. Now, in other words, there is a 65% chance that the portfolio could be completely depleted before year 30 due to market risk in the worst case scenario. So after we analyze the portfolio and we go to a discussion to propose a restructuring based on the same amount of money, same amount of assumed inflation rate, and the same amount of expected withdrawals, and the outcome is that this structured portfolio has a 99.9% chance of surviving more than 20 years or 30 years with a positive balance. In other words, there's only a 0.1% chance that the portfolio could be completely depleted after 30 years. Now, you look at this again, before restructuring, there is a 10% chance that the portfolio could grow from a 3 million today, to a 47 million or even over 100 million in the next 30 years if the market performs very well. After restructuring, the best case scenario, says that today's portfolio of 3 million could only end up with a 35 to 40 million best case scenario in the next 30 years. But if you compare that with this before scenario, the best case scenario could be around 40 to 100 million after 30 years. So the main takeaway here is that a well-structured retirement investment portfolio minimizes the risk of running out of money, before or after 30 years, with almost no chance of a worst case scenario of depletion. While the best case scenario returns may be lower in a volatile portfolio, the overall stability and security of a restructured investment portfolio for retirement make it more reliable and an option for long-term financial security and legacy planning. And this is what we do for you when you come over for retirement advisory. I'll show you more case studies how portfolio restructuring for retirement can secure your retirement income, at the same time reduce the risk of running out of money. So see you tomorrow, or maybe not if you don't already follow me on IG, TikTok, or YouTube.